Welcome to Private Equity Profits. Clifford Locks is a certified board of director, a trusted confidant to CEOs, C-level exec, and high-potential employees to help them clarify goals, unlock their potential, and create actionable strategic plans. Seth Green is the nation's foremost authority on growing your portfolio companies with direct response marketing. He is the founder of the direct response marketing firm Market Domination LLC, and he is an 8-time best-selling author who has been interviewed on NBC, CBS, Forbes Inc., CBS Money Watch, and many more. Cliff and Seth interview top players in the financial sector, focusing on private equity firms, venture capital companies, and family offices, discussing developments and trends shaping the industry. These experts will share with you how they've grown their businesses and increased profit, and how you can too. And now, here's your host, Cliff Locks.
Welcome, everybody, to another episode of the Private Equity Profits Podcast. I'm Cliff Locks, your host, and today's guest is David Garofalo, the Chief Executive Officer, President, and Chairman of the Board of Directors of Gold Royalty. Gold Royalty Corp is a gold-focused royalty company offering creative financing solutions to the metals and mining industry. Its mission is to invest in high-quality, sustainable, and responsible mining operations to build a diversified portfolio of precious metal royalties and streaming interests that generate superior long-term returns for their shareholders. David is globally recognized as the chief executive with over 30 years of experience in creating and growing a multi-billion-dollar sustainable mining business. He is here to educate us on how important the precious metals royalty market is to the mining industry and how you can diversify your investment portfolio. David, thanks for being on the show today.
I'm delighted to be here. Thank you for having me on, Cliff.
It's a privilege to have you. Tell us about your background and how you ended up in the gold industry.
Well, I'm a financial guy by training, started my career with Deloitte's back in the 1980s and got my CPA and started in a very junior position with a base metal producer called Inmet Mining in Toronto, Canada. Worked there for about 8 years and we were building mines at the time. I was involved in the commercial side of mine construction and then joined Agnico Eagle, one of the biggest gold producers in the world. As CFO, was there for 12 years, spent 6 years as CEO of Hudbay Minerals back on the copper side. And then most recently, I ran Gold Corp until the merger with Newmont in 2019, which created the world's biggest gold company by market cap and production. And it was the world's biggest gold merger until the one announced today between Newmont and Newcrest, which is likely to be larger. It succeeds and gets across the altar.
Very good. So that's going to need some federal approvals at that point.
I would expect so. It's, a multi-jurisdictional cross-border deal, Australia and the United States. And I expect there'll be Australian foreign investment review proposals that will have to be made to the government. And so I'm sure it's a complicated exercise. And as you can imagine, with a merger, it's probably in excess of $60 billion. It might take a bit of time to come to fruition.
Okay. What was it specifically that drew you to this industry?
You know what? Canada is a trees and rocks economy. Natural resources are just so fundamental to and foundational to our economy. It's hard not to get drawn into natural resources. And I didn't have any particular focus on it when I was at Deloitte's on the audit practice. In fact, I was doing financial institutions and retail, but I was drawn into a very junior position in the mining business and frankly fell in love with it. I didn't expect to spend 33 years in it. But when I started into it, and it's so capital intensive, it's so dynamic, we're constantly replacing depleting assets, we're constantly investing back in the ground. It's a very, very exciting industry to be in. It's cyclical as well. So we have booms and we have busts. But if you can build a business that sustains itself through the ups and downs in the cycle, it's very, very gratifying.
That's important. In other words, you're looking at it, what is the cost to bring up an ounce of gold and actually be able to put it onto the market and make a profit? And that's simplifying it. A low-cost producer really is amazing. And then I guess you're looking at some of the geology that's involved in the predictive analytics to be able to find veins. I guess I'm using the right terminology of gold and the mining that's taking place. What is your approach to investing in gold?
Well, gold, well, I should take a step back and maybe talk about gold as an asset class, and then we can talk about
Please.
ways to invest in it. And,
Mhm.
there's a lot of similarities in the inflation cycle that we're experiencing now to the last big inflation cycle in the 1970s. And it's worth noting them. We started the 1970s with the US dollar being decoupled from the gold standard.
Right.
And that was to fund a war. Frankly, Richard Nixon needed to print more dollars to fund the Vietnam War. And today we're experiencing a war in Europe. And I would say the decoupling of fiat currency from reality happened in the credit crisis back in 2008. And we saw a vast amount of money printing going on, much like we saw in the 1970s. And that continued unabated for 13, 14 years until we experienced the inflation that we're currently suffering from. We also saw a significant energy crisis in the 1970s, where we had an oil embargo imposed upon us by the Arab world. Today, it's a self-imposed energy crisis, one where we're not buying Russian product anymore, and that's resulted in inflation of energy prices, and that's impacted the supply chain, much like it did in the 70s. So a lot of the hallmarks that we saw in the 70s, that inflationary cycle, are present today. I'd say there's one key distinction. One is that back in the 1970s, debt to GDP globally was only about 100%. Today, it's 350%. It's 3.5 times the amount of debt on a relative basis. And back in the 70s, when Paul Volcker was running the Federal Reserve, he could raise interest rates to tame inflation. He had this latitude to do that because debt levels were manageable. Today, they're unmanageable. And so that's why the Federal Reserve is already talking about pivoting away from higher interest rates, even as inflation is still above nominal rates. So real interest rates are negative still today. We're likely to see inflation become quite entrenched for quite a long period of time. Gold back in the 70s and early 80s reached a peak at the time of over $800 an ounce. Okay. And if you inflation adjust that to today, that would be over $3,000 an ounce. So we're well away from the real all-time peak for gold. And I would argue this inflationary cycle is likely to be quite a bit more persistent for quite a bit longer than what we saw in the 70s and 80s because of the lack of latitude the central banks have to really tame inflation. They can't raise interest rates without bankrupting governments. The fiscal balance in the US is precarious, to say the least. Debt service has risen to $1 trillion a year. And that's one out of every $7 in tax revenue raised by the federal government. So you can imagine if rates went up 300-400 basis points, what that would do to the fiscal balance in the US. It would be very, very difficult. And in the emerging world, it would lead to bankruptcies of governments and the destruction of fiat currency. So gold is the one currency you can't print, can't be manipulated, isn't anybody else's obligation. So I would argue that we're going to at least see the peaks that we saw on a real basis back in the 1980s. That suggests 3,000 an ounce and above. And the question you have to ask yourself, if you believe in that investment thesis, is where to best play gold. And there's several ways to play it. You can buy the physical quite readily. You can go to a bank with your driver's license and then get the gold bar, get the coins, and figure out where you're going to store it, whether it's in a safety deposit box or under your pillow or your mattress. And of course, there's a cost associated with doing that. You have to pay for the storage. Or you can buy an ETF that's physically backed by gold, the GLD on NYSE. And again, you don't get to touch and feel the gold, but there's physical backing there. But of course, once you own the physical commodity, whether it's an ounce of gold or 10 ounces of gold or whatever, it doesn't grow in size. And that's typically why investors quite often look for leverage to the gold price by buying the mining equities.
Excellent.
And mining equities provide you increased profitability that is outsized relative to the increase in the gold price. Margins expand disproportionately higher. That's assuming that costs are stable. But of course, in the mining industry today, they're not immune from inflation that we're experiencing in the general economy. So they're dealing with cost pressures. And so the margins are being eroded even as the gold price has been quite strong. And that's why after 33 years of building and operating mines, I've switched over to the royalty business. And that provides you the best of all worlds because it's top line exposure. We own a percentage of the revenue in over 215 mines and projects within our portfolio, Gold Royalty Corp. And that means that we get a percentage of the gross revenue from those mines. And it doesn't matter what happens to their costs. We protect our investors from cost inflation. And we have a very scalable business as well. I can run a business like that with 215 assets with only 8 employees. And I could run a business 10 times the size with the same number of employees. It's a very, very scalable business. That means our cost structure stays low. And even as our revenue grows, that goes right to the bottom line. And that's why only 10 months after our IPO, we actually introduced a dividend. We pay a 1.6% yield.
Okay.
And we believe that dividend is likely to grow as we realize that revenue growth that we expect from that vast portfolio that we've assembled within the Americas of gold royalties. And the other feature of a royalty company is we provide exploration upside. You get that from mining producers as well, but we get that without actually having to pay into the exploration budgets. Once we own a royalty, we own it in perpetuity.
Okay.
There's no capital calls. So when our operating partners, upon whose assets we own royalties, decide they're going to explore on their properties and grow their resources geologically, we get the benefit of that as well, but we don't contribute to the exploration budgets. Last year, for example, our operating partners invested $200 million in their exploration budgets. We contributed nothing to that, but we got the benefit from the growth in the resources realized by their drilling. And so that's really the attractive thing about royalty companies and why they've perennially outperformed both the commodity and the mining companies as well, because of, again, that top line exposure to exploration upside, while providing you complete protection from inflation.
Let's get into the forensics of it. In other words, the mechanism. So that our PE, private equity companies, or ultra high net worth individuals will write a check to your fine organization. Now, you're public at this point.
That's right.
So which particular exchange are you on?
We're on the NYSE American under the trading symbol GROY, GROY.
Okay. Those funds that you'll put to work at this point, tell us what you're going to use that cash that's going to come into the organization when they buy shares.
Yeah, so quite often what we do is we invest in new royalties. We'll help finance the development and exploration activities of our operating partners to help them de-risk and grow their assets, put them into production, expand them. And then we take a royalty back in return, and that royalty stays with the property forever.
Excellent.
So it could change operators. The operator could go bankrupt, but our royalties permanently adhere to the property. It's bankrupt proof. It protects itself from changes in ownership. So we're there forever. And that's infinite optionality to the exploration success of the underlying operators.
So in essence, you have a deed on what is being pulled from that particular mine at that point. It doesn't matter who is actually doing the operation at this point.
Yeah, and that's precisely why we focus on low political risk jurisdictions. 75% of our royalties are in Nevada, Quebec, and Ontario.
Very
the
good.
3 best jurisdictions in the world is judged by the Fraser Institute for mineral potential, low political risk, and low regulatory risk, because that legal framework is absolutely vital to the sanctity of our royalty portfolio. Yeah, that royalty court ruling stays adhered permanently to that property. It's protected from, again, changes in ownership, bankruptcy, and I think that's important. We can't do that in a third world country. It has to be in a country that has the rule of law framework on which royalties are respected, also adhered to by the court of law.
So when we look at this, you're going to the potential investor at this point has got appreciation plus a dividend.
Yes.
Okay. And that's really the value proposition that they go in. So when they're looking at a good investment, they're going to be looking at those two returns over time, and you're buying the future cash flow for the organization.
Yeah. And underpinning that is 60% compounded annual growth in our revenues over the next decade.
Okay.
Because of the significant pipeline of projects we have. We have 8 mines that we have royalties on that are currently in production, generating cash flow. There's another 15 that are in various stages of construction. That's what provides that growth trajectory that I talked about in revenue earlier on. And then we have 180 royalties that are from early stage exploration right through to feasibility study that provide us a lot of organic growth forever.
Tremendous.
And of those 215 royalties, we've bought and paid for all of them. There will never be another cash call in any one of those royalties. We just have to wait and collect the checks.
Very good. So are you sitting on the board of some of these organizations at this point? Your representation?
No, we don't.
Okay.
need to. We have very strong relationships with our operating partners.
Okay.
We have a manager of operations whose job is to focus on getting information flow on a regular basis
Very good.
from our royalty partners. And we get invoices every quarter. We collect checks every quarter. We collect expiration information so we can share the expiration upside with our investors. Again, that we're not funding, but we're getting the benefit of by virtue of our partnership as a royalty provider, delivers significant value over time.
Let's change the topic a little bit. Let's talk about challenges and pitfalls associated with investing in gold. Some of you covered earlier, but I'm also looking at the tax side. In other words, you got a depleting asset there. There may be depreciation. So it's just learning more on how this plays out.
Yeah, no, it's a significant challenge for the industry, and that's why there's so much M&A going on in the industry right now. Since 2012, when we came out of the credit crisis and gold had a big surge at the time, there was a lot of investment in new properties and exploration coming out of the credit crisis, but that led to significant cost inflation and a lot of frustration among investors, who then basically dictated to mining companies they had to harvest what they'd already built, and that's what they've done since 2012. And as a result, reserves in the ground, gold reserves in the ground, have depleted dramatically. They're down 40% from their peak in 2012. The average length of a mine deposit now is only 6 years. That's an existential disaster, because it takes typically from discovery to first production up to 20 years to build and operate a new mine. That downward trajectory is not going to reverse itself anytime soon, because the industry's underinvested dramatically in exploration in the ground. They haven't replaced their depleting assets through their exploration efforts. So we're not going to see a rebound in reserves or production anytime soon. That's why if you're not finding it, you have to buy it. That's why, you're seeing Newmont taking over Newcrest, why Newmont took over Goldcorp back in 2019, and Barrick took over Randgold. We saw large scale M&A, and we saw Agnico Eagle recently take over both Kirkland Lake and Yamana. These companies are starting to combine themselves because they can't replace what they've depleted. But of course, if you look at the industry holistically, that's a zero-sum game, because that doesn't result in additional exploration in the ground. It's just combining the depleting asset bases of various companies in order to sustain the production levels of individual companies, but does nothing for the industry in terms of reversing that downward trajectory in reserves and production.
It's a low-cost provider. I mean, I guess the mining operation and the intelligence they could bring in there to find more deposits. He's finding the geological side. Is it improving at this point?
Well, I would say the technology has moved forward incrementally in terms of finding. I think you led with talking about artificial intelligence earlier on, and we are starting to use AI, for example, and the predictive analytics from it in order to reduce the lead times from generating exploration target, discovering new deposits. That's historically been a very labor-intensive manual exercise by geologists. If we can digitize all of the historic exploration information, which we're doing increasingly in the business, that'll reduce that lag time from generating to discovering. And so that will help, but it's very, very incremental. You're still looking at significant capital intensity, permitting challenges, social engagement challenges to get new mines built. Not in my backyard is a big issue in our business. They don't want mines in their backyard, but they want the metals from them, which is a conflict that society is dealing with perennially. And as a result, I don't think the lead times are getting shorter, they're getting longer from discovery to first production. So that's the challenge. And it's not just a gold industry challenge, it's a mining industry and natural resources industry challenge, particularly when you consider battery metals and the need for them for electric vehicles and whatnot. I don't know where they're going to come from to electrify our vehicle fleets globally. We need a lot of copper. We need a lot of battery metals generally in order to do that. But unfortunately, the mining activity has not been ramped up in response to our objectives to achieve that kind of decarbonization. We're nowhere near there.
Yeah.
And so that's going to result in a squeeze in the mining industry generally, and a squeeze upwards in prices, whether it's in precious metals or base metals or battery metals.
Excellent. You're bringing up something extremely important. Others, they're drawing down on inventories. Inflation really has not decreased demand very much at this point. So the price of these fundamental, what we take for granted is the raw materials to go into these products, is going to skyrocket. There's no question. And it's going to be much higher. You were nice enough. I think I heard you share that you thought maybe inflation was at 15%. It could be a little higher at this point, the true cost, for an individual to actually buy what they need to support their families. As the feds are releasing some data on inflation, they're not really being honest with us, the consumer or businesses. So you have to judge gold holds its value. So if we had 1 ounce of gold back in, let's say the wild, wild west, we could buy a suit of clothes for the same coin. And today we can buy a suit of clothes for the same 1 ounce coin. So, it does hold its value. There's no question to it. Legislatively, it is getting harder with ESG, and people are much more vocal on, as you suggested, the mining. The decarbonization, and I have equity in a hydrogen organization, and we can use electrolysis with salt water without desalination, so it reduce the energy needs. So we're still looking at this thing where they're still trying to use battery technology, as you're suggesting, and there's not enough material out there to actually fulfill what they're envisioning on a decarbonization with storage. And storage has got to be a key piece of it if you want to move to a green solution. So I want to salute you for bringing up bright minds. Hopefully will continue to articulate their expertise. And you've got the fundamental knowledge on minerals, the idea that we can actually mine it or recover it, deploying it into the battery technology. It's just not there. We can go down to Chile, or unstable areas, and we can continue to try to mine, but at some point, this is not going to have a very positive outcome. I like your business model. I think it's very, very sound. Let's talk about how these trends are changing and what's making them change. The underlying aspects of it, why what you're bringing to the market is such a positive force.
Well, look, I think we can look at distinctly base versus precious.
Okay.
Gold is a bit of a different animal. I wouldn't characterize it as a commodity per se.
Thank you.
And I would characterize it more as a currency. It's a financial instrument. And the way that currencies trade relative to each other is relative interest rates. And gold has and will always yield zero. Treasuries today yield negative on a real basis.
Very good.
And that's what's driving capital into gold as an asset class, is because investors understand that their capital is being eroded through the insidious nature of inflation. Even with interest rates going up on a nominal basis, they're still deeply into negative territory and likely to go deeper into negative territory as the Federal Reserve starts to pivot away from higher interest rates probably later this year. And so gold will protect your capital from inflation. So it's a different animal. And I would say that the move upwards in gold, when you start to see a rotation of capital into gold reflecting that reality, can be quite violent when it happens, because gold is very, very finite quantity. If you took all the gold that's been mined since the beginning of man, it's 200,000 metric tons, which sounds like a lot, but in fact would fit into an Olympic-sized swimming pool. It's volumetrically tiny.
Wow.
It's tiny. And it's a very, in terms of capital allocation globally to gold, it's a fraction of 1%. So even a minute reallocation of capital into gold would drive gold up violently. And so I think that will happen when the reality of inflation and the erosion of capital hits people, and they realize their capital is being eaten away every day by inflation. Base metals are different. Base metals are driven by demand supply fundamentals. And certainly we talk about the battery metals, the lithiums and the cobalts, and I think they're important. But if you look at electric vehicles, and you can see their mandates in California to be half electric by 2030 and fully electric by 2035, and that tends to drive the rest of North America towards whatever standards California sets. Well, the amount of copper in an electric vehicle is 3 times what it is in an internal combustion engine. It's 600 pounds of copper per electric vehicle. If you can imagine that, it would drive copper demand to double where it is today by 2035. I have no idea where that's going to come from. Listen, it's a small enough industry. I know every copper project that's in construction right now in feasibility study. I've built a few copper mines. I built one of the biggest in the world in Latin America, in Peru. And Peru's having its challenges politically right now. I just can't imagine where we're going to get the supply needed to achieve the decarbonization efforts that the governments have mandated. Governments do a great job of setting lofty objectives, do a very poor job of understanding the supply chains needed to support those objectives. We're nowhere near there. On the one hand, here in Canada, we have a government that's mandating the same sort of electric vehicle objectives as California, but won't permit new mines. Where this copper is going to, and we are a natural resource rich country. It's the disingenuity of the government is breathtaking to me, or the stupidity. I don't know, one of the two, but it really alarms me. And what it means ultimately is copper prices are going to go to the moon in order to achieve the supply objectives that these governments are mandating in the electrification and decarbonization of our economies.
It's more than just the canary in the mine at this point.
No pun intended, right?
Yes. We have a serious global situation at this point. It's being driven by the political environment. I understand they're looking to get reelected and there's some pressure on them. You got a narrative there that's not going to be delivered. The utilities, that are keeping the power on, specifically in the United States, across the United States. And you're listening to the utility executives are hugely concerned about being able to continue to move towards decarbonization. And this is the perfect storm. And you were kind enough, you brought up the battery, technology, and there's some other technology out there looking to do some storage. And you're really not writing the large billions and billions of dollar checks that need to be for the R&D to actually move that science forward. The Department of Energy is releasing some money at this point, but at a very, very slow pace. And it's not going to take place 2030, 2035, 2050 to be able to see that. What's going to happen, I'm in Connecticut, the electric rates have doubled, in a year. It's got to be putting stress on the families. What about a business that's, heavy energy? I guess the question is, will there be pushback? So you're bringing in something I think is very, very important. So in essence, an investment in gold is recession proof. It actually holds its value very nicely. Let me ask you a question. When you look at the gold reserves and you see multiple countries repatronizing the gold that they own, somebody's wise to something at those government, organizations or those countries to take the gold back.
Yeah, not only that, they're buying up all available production. I'll give you a very tangible example.
Please.
China as a country is the biggest producer of gold in the world.
Okay, thank you.
Bigger than any other country in the world. They are also the biggest consumer of gold in the world. None of the gold they produce leaves their shores. They're also the biggest importer of gold. So not only are they consuming everything they produce, but they import more than any other country. And what that tells you is, by nature of their economy, they're dealing with an avalanche of foreign currency proceeds, in particular the US dollar.
Right.
Their central bank and individuals are diversifying into gold as fast as they can.
Okay.
Because they recognize the devaluation of fiat currencies is occurring on a global coordinated basis by central banks. And central banks recognizing that, particularly in the emerging world, are diversifying into hard assets, into gold. Because if you think about it, gold is finite, hard assets are finite, paper is infinite.
Right. Well, as we speak, we have over $31 trillion in the United States in federal, in debt. There's no way we're going to pay that off.
No, you'll inflate it away, just like every country in the world is doing. And they can't resist the temptation to diminish and demean their fiat currency. They're doing that because there's no fiscally responsible way for them to repay the debt.
Excellent.
They have to make it inflate away by printing.
I think our listeners have really received a very high level executive MBA education, during your conversation. Is there anything I haven't touched on that you would like to add?
Well, look, I really do believe in the value of being exposed to commodities, and there's so many dynamics driving that. And gold in particular, it's again a financial instrument. It's one that's going to preserve your wealth in an inflationary environment that we're likely to unfortunately experience for many, many years to come, because governments are not willing to deal with the debt levels that they have in a rational way. There's just no way for them to do it. They piled on too much. Right. And on the hard commodity side, on base metals, we just need more metals to deal with the climate crisis. And I do believe there is a climate crisis, and I believe we need to decarbonize to do that, to deal with it. And unfortunately, it requires a lot of metal to do that. It requires a lot of mining effort. And unfortunately, we're going to have to see a big squeeze up in prices to drive capital and drive the political will to produce the kind of supply we need to meet our economic demands. And so that means much, much higher prices than we're experiencing currently for all of those commodities.
It's going to be a painful period. David, how can our listeners contact you? Are there any links you would like to share?
Sure. We're goldroyalty.com is our website. So very easy to remember. I like to say we're the Kleenex brands of gold royalty companies, precious metal royalty companies. Is a very generic name. Mm-hmm. And as I said earlier on, we're GROY on NYC American. We also have publicly traded warrants as well on the NYC American under the same trading symbol. So if you're looking for a bit more torque, is GROY.W for the warrants. We pay a 1.6% yield. So delighted to share the annuities that we're enjoying from our royalties with our shareholders.
One of the earlier questions I want to address is the tax implications of buying your shares and the dividend. Is there anything tax-wise that makes it even more exciting for our listeners to write large checks and to support your endeavors?
Well, look, I think dividends are an attractive way to be paid to hold while you're waiting for capital appreciation, notwithstanding what the tax implications are. And I loathe to provide tax advice because I appreciate a lot of your listeners are in probably various jurisdictions. They're all different. I just say consult to your tax accountants and make sure that you get the best advice possible. But what I would say is, look, there's nothing unusual about our company. There are many cross-border listed Canadian companies on the NYSE, and we're among many, I'm sure that you already own in your portfolio.
I want to thank you so much for your time, David. Your advice on investing in gold is something anyone listening can benefit from. I want to thank you for sharing that vision. I want to thank our listeners. I look forward to being back with you shortly for another episode of the Private Equity Profits Podcast. This show has been produced by Market Domination, LLC.